Hi, everybody. Mike White here. How are you? I hope everybody's having a great day. Hope everybody's enjoying the end of the summer season and beginning the fall season. Today is a particularly important call, and I'm glad that the timing of this call being available and this information all coming together at this time was pretty good. I had something else planned for this session, and I pushed it to the side because, as we are aware, last week was a pretty significant week in our business. So, last Thursday, the Fed got together and had their meeting and made a big determination that they were going to grace us with what the markets are now calling QE3. So part of this conversation has got to be QE3 and what does it mean to me. And those of us in the mortgage business are going to have to deal with a lot of questions and a lot of challenges when it comes to exactly what this is. And unfortunately, we're not going to know everything that goes on here. And a lot of the results are going to depend upon other things. But I do want to share with you what we know so far and have this conversation and this dialogue so that you are prepared, because one of the things I want to make sure that happens is that, when things happen and we have to look at them, we can collectively come together and share what it is we know in our experiences so that we can all benefit, so that if mistakes are made, we all don't have to make them, that we can kind of help each other through it. So let's just take a look at all the things that have happened, and let's take a look at this QE3 and specifically what this comes into. So QE3 really it's $40 billion a month in mortgage-backed security purchases. They're going to be buying mortgage-backed securities at an astounding rate indefinitely into the future. And the reality of this is, it's an unbelievable amount of money, and we'll get into that. They've also continued their conversation about no hike in rates until, the earliest 2015, and they're going to continue with their bond purchases as they have. So all the things that they have done in the past are going to continue, and now they throw an extra $40 billion into the mix here. It's an astounding amount of liquidity, incomprehensible to a lot of people, and I just want you to just keep in mind something that's very important, that $1 trillion is a million, and what this looks like here is $40 billion a month. This is not a one-time thing, but $40 billion a month is a tremendous amount of money. And if you just do some simple math, you can see how that adds up very quickly. And the words indefinitely into the future are something that we have to deal with. So the instant reaction that we have to this thing and that the markets had to this thing is that just the shock at the size and scope. There wasn't anybody that was out there who expected something like this was going to take place, and certainly not to the degree that it did. Initially, oil prices went up. In fact, we edged up over $100 a barrel, and gold and silver prices started to climb. The stock market jumped up over 200 points in just a few hours on Thursday afternoon. And, aside from a little bit of movement back and forth, by the time the mortgage bond market closed, we were well over 100 basis points above where the day had started. And that is a huge amount of money. Now, think about that, and it may not have transitioned, all into the rate market, because we gave back a little bit of that on Friday, as you would expect before a weekend, and certainly given the news about what had taken place in the Middle East. But we recovered again on Monday, and again, looking at your rate sheets, we really have to look at this and say, where are we, what are we doing, and how are we going to deal with this? Because the reaction to this, again, are going to be largely unknown, because so much of what happens in the marketplace is predicated on how people feel about it. What is their interpretation of this information? And so what I want to go through with this is to paint a picture as to where we are and what this looks like and what we need to be prepared for. Because there are going to be a lot of questions, or maybe not. Maybe this whole thing took place, last week, and because of the incidents in the Middle East and because of the fact that we're in the middle of a presidential election, that maybe this isn't getting the media play that something like this might ordinarily. You don't know how long it's going to take before the articles come out where people start to read and react and what their overall feeling is going to be. So let me share with you some short-term thoughts. Is what is the media take on all of this? And I don't know about you. I've read some articles. I've heard some people speaking, but there hasn't been a whole lot of conversation over this weekend about the details of this and the size and the scope of it. There hasn't been a lot of conversation. It's been kind of just talked into the situation that this is QE3 and people have heard of 1 and 2, and it didn't really have that big of a deal. So the media take is largely, not there. This type of a move, right before an election is, very uncommon. Generally, the Fed tries to stay non-political, and the Fed tries to stay away from, picking winners. And, clearly, regardless of which way you come down, this is a really big move, and it's a really big decision. And so, it is something that generally doesn't happen. So there must be either some information that the Fed is seeing or interpreting or worried about, and maybe it was the fact of the jobless report for August, where we only gained 96,000 jobs, but the serious part about this was the fact that 3 times as many people just quit looking for work. That was probably the scary number. I don't know if it was scary enough for the Fed to make a move like this, but it certainly is a challenge. So that is, it was kind of slow. There's not a lot of response in the media about something like this, and so we're going to have to see how it plays out, and you should keep your antenna up. What was the general perceptions of the people? And again, by and large, if the media isn't covering it, most of the people having a conversation about this are people like me and you who are in the mortgage business, who follow these things closely because it has an impact on our business. And so the perception of the general public is still yet to be seen. It's Tuesday. We're 5 days after this decision has been made. We had an entire weekend to go through, and there's not a lot of people really talking about this. I don't see it in the papers. I don't see it on the websites I generally go. So, and I don't know if you're seeing it. I don't know if people are bringing it up. But the fact is, it's an awful lot of money to come into the mortgage arena. So we have to ask ourselves, how quickly will mortgage rates respond? And I think we got a pretty good answer to that right away. If those of you who are dealing, as correspondent lenders, or even those who are dealing Fannie Freddie Direct, or for those of you who are brokers, the reality of this is, if you look at the market, we dealt with last week what was the G fee increases. And depending on who and where you get your money from and who the conduit is and what their risk aversion or what their circumstances were, that G fee was anywhere between 30 and 60 basis points that should have been added to the rate. And by most accounts, it was, in everybody's rate sheets by Wednesday or Thursday. So if you were looking at rates, that you would have noticed that Wednesday or Thursday of last week, your rates were slightly higher, an eighth, maybe a quarter different in where you were, because we had to swallow up and add the G fee into what it is the pricing went to. Well, the other thing that the mortgage market had to deal with in this increase was the G fee, was the fact that by such a dramatic drop or potential dramatic drop in interest rates, with the Fed running out to buy up so much of the supply, that it's going to put pressure on rates to go down, and lenders had to look, investors had to look at their portfolios, especially those with large refinance portfolios, and try to deal with pricing in the risk of those loans falling out and being replaced by loans at lower rates, and how much was that going to cost them. So the question is how will rates respond? We're still wading through all of that, and we have to keep our eyes open, because very simply put, they have responded. Rates are somewhat lower, a little lower than they were at this point last week, and that's significant considering the addition of the G fee. Now, will that mean we're going to see a 2% or a 30-year fixed rate in the 2s? Well, we have to deal with that, and we have to look at that and see where this all goes. Clearly, right now on all investor rate sheets that are out there, since there's not a 2% coupon or a 2.5 or a 2 3/4 or anything with a 2 on it for a 30-year paper, it's tough to get there. You run into the wall of why would people invest in a 30-year loan when you could, at the same rate that you could get a 30-year Treasury at. So one of the things you have to pay attention to is, in all mortgage rates, the rate that gets charged to the customer, part of what's built into that rate, in addition to what the G fee may be, are also servicing fees, etc. And so that also takes into consideration that the person who is buying, what their real return is going to be. So, we're going to see pressure, and the idea is to be paying attention to the fact that looking at your rate sheets, and I'm not saying at par, I'm saying anywhere on your rate sheet, when you start seeing 2% money, if it does appear, then you know that there's a license for the pressure to put on there. But understand, the Fed's not coming out and buying, a $500 billion worth of loans today. They're buying $40 billion a month, and that adds up to $500 billion a year. You don't have any idea how long it's going to take for that to happen. So the reality of this is we have to be prepared. We have to know what to do. We have to know the questions that are going to be asked. Example like, do we lock now or do we wait? And the answer is twofold. If you're a purchase loan and you're sitting here, then the advice would be is to hang out and float as long as you can, because the pressure is going to be for rates to go down. If you're refinancing, the challenge becomes is there's nothing on the horizon that tells me these rates are going to push down significantly lower than where they are today, and we'll explain a little bit of that as we go forward. But the reality of it is the fact that if this is a long-term situation, if the administration remains this administration through the election, and if the chairman of the Federal Reserve remains in his job, then these are clearly policies that they've put forward and will execute. And if that's the case, then the build of this $40 billion a month will be compounded over time, and you will see pressure on rates to go lower, and it will generally look that it will follow that 30-year downward because the Fed is still in a position of buying bonds, not only mortgage-backed securities, but they're also buying, Treasury-issued debt. And so all that comes into play. And you can see some of this stuff in the numbers, and if you are big into following the numbers, I would suggest that you spend a little time, not a lot, 5 minutes at most every day, paying attention to, once in the morning and once at night, where's the bond market, where's the 10-year, where's the 30-year, what are mortgage-backed securities doing, and making sure that the investors that you're working with, following their rate sheet and seeing who's the person that puts the number out there first, if you're ever thinking whether or not we're going to get into the twos. Because the answers really we need to have. And in your mind is will entire pipelines of processed files all now need to be renegotiated? See, that becomes this scary thing. This is, people are going to have to start pricing that in. Is what if, between you taking loan applications and your processes, processing the loan and getting these things set up, especially refinances, there's no legal obligation for those loans to close. That may be money that you never recover, maybe money that the investors never recover. And depending on the balance of your portfolio, if you've got a high degree of refinances in there, you could be looking at significant challenges as to work that has been done that you may not get paid for. Now, the longer-term view of this and what we have to set back from, okay, is that, again, if this goes on, it's $480 billion. That's $500 billion. And billions and trillions are scary because not a lot of people understand what a billion and a trillion are. They don't have any perspective. So let me give it to you another way. $1 trillion is a million. And most people can understand what a million is. They have an idea. If their house is worth $200,000, then $1 million would be 5 of their houses. Or if they make X number of dollars a year, they know how many years they work to have made $1 million. They can come to grips with that because those are all things that they can do some simple math and figure out how it relates to them. And how does it relate to us in our business is understand that $480 billion a year in purchases amounts to a little over $4 million in loans for every licensed loan originator that there is in the country. Think about that for a second, okay? That's barely what the average loan originator, does in a year if you use the current math. If you take those numbers and you look at them and say what percentage of the business is the government buying, it's a little over $4 million for every loan officer who's licensed. That's a pretty big number. Now, the other part about the long-term view of this thing is we have to ask these questions. The Fed is doing this action, and they said they're going to continue to do it until the economy improves and until housing market improves. And so the question remains is, can this action solve the problem? And my quick response is, it hasn't so far, so why would it now? The housing market was in trouble. Interest rates were not 3. Interest rates were in the 5s. We've lowered rates dramatically since the housing, market, the mortgage meltdown happened, and we've been lowering rates to where now they're virtually 0. And housing or mortgage rates have gone from 5 to 4, and that didn't spur anything, and 4 to 3, and that didn't spur anything. So shoving rates down into the low 3s and possibly the 2s, what makes anybody think that that's going to improve the housing market? And were there better options to spur a housing recovery? Think about this. The government already has connections to most of the mortgage loans that are out there. By owning, Fannie and Freddie and being responsible for them as well as everything that comes through HUD, having their connection to all that money, if this was truly about spending money and putting $500 billion a year into the economy, why in the world would they do it this way? How is buying these existing loans going to do anything? My argument here would be is raising rates would have spurred the economy, or making a statement about raising rates would have spurred the economy far more than this would. Imagine if the Fed on Thursday would have come out and said, guess what we're going to do? We're going to start raising rates 1/4 point at every FMOC meeting from till the housing market, until unemployment gets below 6% and the housing market gets back to more normal business. The flood of housing activity between now and February would have been overwhelming. And the realism that the fact that as soon as the Fed actually did hike rates in February, that they were serious about moving this thing forward, would have created a lot of pressure on people to get inventory cleared out, get the adjustable, get the properties who were in either short sale or foreclosure done and into the market so that it could be sold off to meet the demand of all these people who now want to commit to buying these houses before rates actually went up. You could have used that money instead of buying these loans. You could have, if you wanted to, have negotiated with the people who are currently upside down, or anyone for that fact, who is in a loan right now where they can't refinance for whatever reason. If the Fed would have just come out and said, here's what the new plan's going to be through our government agencies, instead of using this money to buy mortgage-backed securities, we're simply going to go out there and we are going to put in place, we're going to make sure that Fannie, Freddie, and HUD refinance everybody in this country who's got an existing mortgage loan, who has been making their payments on time. And we're going to convert every one of these loans down to 3.5%. And there's absolutely nothing involved. The only criteria would have been, have you been making your payments? And that way it would have been equal. For those people who are upside down on their loans, it wouldn't have mattered. They would have been able to refinance those houses, and they would have been able to lower their payments. For some people who decided that the only option to get a loan modification was to stop paying, and unfortunately in this country that's what has happened, we could have held the provision that once their payments get back to that they are 12 consecutive payments, they could take advantage of this as well. So if they would have either got caught up or at least made their next 12 payments, then they would be eligible for this program as well. That would have spurred a lot more housing activity than simply putting pressure on rates that really, until there's a 2% coupon out there and until the 30-year bond falls, there's not a lot of room for them to go. And as we've seen in this marketplace, there's not a lot of people out there that are buying, when they're left to their own devices, they invest where they need to invest the money. And some of that money just stays on the sidelines. So while it may rally the stock market somewhat, because some of that money will go into stocks and, into the stock market because they're not getting a return in the mortgage-backed security market, there are a certain number of people that are, funds and things that are held that are only designated to go certain places, and these people have to use their money to buy whatever happens to be available because their fund dictates that. It says if you are a mortgage-backed security fund and there are people who are putting their money in there and that's what they're investing in, you don't have the luxury of going out and doing anything other than doing that. So the reality here is there are a lot of other things that could have been done, but we're saddled with the program that has been put in front of us. And we have to look at that and start asking these questions. If fixed rates are going to benefit, we have to also understand, well, what about adjustable rates? And you're saying, well, Mike, what are you talking about? Well, if the government, again, keeps buying debt and keeps pressuring the yields on treasuries, those numbers will go lower and lower. Those indexes will go lower and lower, and they may or may not change the margins at which the banks will operate. Because at a certain point, there is a margin to everything. And what happens? Will those margins grow because we are tied to a smaller number? Will those margins grow because of the activity? Will they shrink? When we start looking at some of these adjustables, most of these things are getting so incredibly low that there's not a lot of room for them to go. So the people who are in those adjustables, where is the room? Not going to happen. So it becomes, will fixed rates benefit? And what about the adjustable rates? Where is the pressure for them to go any lower than they already are? And the answer is, there might not be. There may not be the pressure, because in order for their pressure to be, for loans to for prices to go lower, there has to be a willing buyer and a willing seller. And if the government is the only one who's buying, then there's going to be a challenge, because even the government can't keep, well, they certainly could. They can keep printing money. But for the most part, people do have to buy at a certain price, or they will reallocate, or they will close their funds and they will go home. So you have to keep in mind with these rates and the pressure, hey, if you do get a 2% 30-year fix, that would be a wonderful deal. But you have to watch for it. What about this adjustable markets? What happens to the 3-1, 5-1, 7-1 arms? You need to be paying attention, and you need to be knowing what's happening in those markets. Take a look at these things and realize where we are, because there may be significant benefit to your customers. Now, I don't know if anybody in their right mind who's planning on staying in their house a long period of time could be talked to about taking an adjustable rate loan if you can get a fixed 30-year fixed rate in the low threes. But the reality of it is you need to be aware of it. You need to be aware of what's happening every place in the market, especially under these circumstances, and you need to be able to answer the questions, because they will come up. So let's look at some success strategies, because all this conversation doesn't do us much good if we don't put on paper some things that we can do to resolve some issues for ourselves, our referral partners, and our clients. First of all, you really must know what your answers are going to be to the likely common questions that we've discussed here. You have to be aware of where you're collecting your information, where are you reviewing it, how timely is it? The answer is you have to know where your sources are, and you have to be able to share those sources so that people know where you're looking. Are you looking at the Fed announcements? Are you looking at sources like Bloomberg or any of those places where you're collecting your information? The Internet's a wonderful thing, but a lot of the information that can be put out there, can be incorrect or partially incorrect. So you must have answers to likely common questions, and we know what they're going to be, and we'll go through them. You have to be confident, honest, and not defensive. I know that some people, you may have large pipelines of refinances, and you may be getting people who will start calling, asking about, hey, should I not go through with this refinance if rates are going to go much lower? I hear that rates are going to go lower, and maybe I'd be better off not doing it. You need to be prepared to answer the question in the best interest of the client, not in the best interest of your paycheck. And the reality of it is right now is nothing that we've seen indicates that there's any reason to believe that rates are going to go plummeting lower, that if rates do go lower, it looks that it will be after this first shock of getting this announcement out there and finding out where the confidence is. there may be some pressure on rates going down in the months to come. However, we don't know what's going to happen with the presidential election. We don't know what's going to happen in the Middle East. We don't know a lot of things that are on the horizon that we can see. There is a great deal of turmoil in the Middle East, and there is a presidential election that's going to happen in about 45 days. And those things may or may not have a big effect on what's going to happen into the future, but they are predictable events. There's a lot of tension and there's a lot of uneasiness about the Middle East. And somewhere we're going to come to resolution as to what's going on and how it's going to be handled. And that probably isn't going to be a definitive answer until after the presidential election. Because, if there's the current president wins re-election, then he's got the path that he thinks is best to take. If the challenger wins the election, then there's probably a path that he wants to take. And considering the tenor and tone of this election, they are substantially different. So that becomes a very important thing. What do we think will happen? So the deal is it's a milestone. Well, in a refinance, that situation, we're not going to wait for that. If a person's in a position right now to save $20, $50, $100, $200 a month, whatever the case may be, by refinancing, then it's very straightforward. Let's close your loan. Let's see what happens with the outcome of the election. Let's see what happens if this program stays intact. If we do go down the road and there is a substantial change, it'll likely occur over time. It won't be a short-term, one-and-done type thing. It will be a long period of time before we find out where the new bottom is going to be. That'll give you plenty of time to enjoy the savings that you have by refinancing now and understand that 6 months, 8 months, a year down the road, watching the market, it may be to a point where you see enough benefit in making a refinance transaction happen again. Because sometimes you'll never overcome. Sometimes people wait on the sidelines for the best deal, and by the time they know when the best deal came and went, they missed it. So you have to be proactive with the information. You have to know what the answers are going to be. You have to be confident that you have a strategy. And remember that any information and knowledge, the thing that irks me more than anything are people who go out there and they banty about the phrase, knowledge is power. I got news for you. Nothing could be further from the truth. Knowledge is not power. Knowledge is knowledge. Without having a plan and without having actions, as a result of having that knowledge is just useless. It doesn't help you. So you must have a plan. And the plan is, what are we going to say? How are we going to say it? You got to have a clear policy about your loan locks. You have to explain locking in a loan. You must explain to people that locking in a loan is a lot like having an insurance policy. You lock in the loan, you agree to take this deal because you're afraid the market may go the other way and you will have to pay more. That's the deal. If you think that the rates are only going to go down, then there's no reason to lock until the last possible moment. And for some of you, that's different. Some of you have different abilities to lock in certain windows. There are some companies that mandatorily price at 60 days, some at 30 days, some can go as low as a 10-day. You have to know, looking at your own situation, where are you locking your loans? But you must have a clear policy about it and explain to them, hey, in this particular program, we're locking the loan, and my company has this policy about rate locks. Whatever it is. Some companies, it is what it is, and if you break the, there's all there is to it. Some companies make people pay for rate locks. Some people, they are in companies and they will negotiate a rate adjustment and the client is prepared to understand, hey, you may be at this, but we can get you that if you're willing to pay this amount of money. It's something that can be negotiated maybe once. Again, whatever your policy is, you need to be aware of what it is, and so does the client. Make sure you're setting that expectation up front. Because if you're not clear and if you're not informing the client and your referral partners in writing about what lock extensions cost, what renegotiations may cost, what their liabilities may be, then you've got a can of worms down the road. So you need to be clear on what it is that you can do, because if you're not clear, if you're ambiguous about this point or you tried to hide this point, it's going to become very clear to the people. 100% of the truth, 100% of the time is something that we really must be committed to. We must know what it is that we can do. We must know what our capabilities are, and we must have it in writing. So understand it's a very successful strategy to have a clear written policy about your loan locks, and that the customer acknowledges that they were informed about locks, lock extensions, and renegotiations. So in my opinion, and a lot of this you've already heard, okay, if it isn't in writing, it doesn't exist. You have to have what you're going to do, what your approach is. It needs to be in writing. From the actions that you take on a daily basis to pay attention to your market, to the time in the day that you do this, to what the actual policy may be, and how you convey that information to the client. This is not about hype. This is not about panic. It's not about anything else. It's about knowing how you're going to conduct yourself. There's an election and it's 7 weeks away. Anything is possible. Anything is possible. For those of you who have continually read my blog and have been the recipient of the white papers that I have published, you know that last year I told everybody that 2012 was likely to be the best year ever in the mortgage industry, because you had a culmination of events that were going to take place that never before and may likely never again ever come to fruition. And one of those things was the presidential election. And one of those things was the struggling housing market. These things are all coming together, and the closer we get to the defining moment of this election, the more likely it's going to be that these situations come into play and they become a political pawn in the court of public opinion to sway votes one way or the other. So you need to be aware of what the truth is today and what it was yesterday, and be prepared for what any of these things can be into the future. Because the reality of it is after the election is over, we face the next struggle, okay, is a real budget resolution. A real budget resolution, a real one, would do more to spur the economy and support the housing market than if the Fed bought all the MBSs that were available. That's plain and simple. There's no ifs, ands, or buts about it. This country has not had a budget for 3 years. 3 years. A real budget and a real resolution to what it is that we're going to do about all the challenges that we're facing, or at least make the attempt to deal with, will signal to the market that there's a serious effort going forward, acknowledging where we are. That will relax the pressure on a lot of things. That will naturally reduce the pressure on interest rates. It will naturally reduce the pressure, okay, on the markets, on commodities, on daily prices. But most of all, it'll change the attitude of the people, perception being the reality. If we perceive that there is value, if we perceive that things are going to get better, then they likely will. It's a self-fulfilling prophecy. So the point is, we don't know what's going to happen. There may be a real budget resolution regardless of who wins the election. There are only so many possibilities of what the outcome could be, both with the presidency, the House, and the Senate. There's only so many combinations of what can happen. And depending on what the results are, there will either be a mandate or further confusion one way or the other. But what will happen here is a budget, a real budget getting put into place and not a continuing resolution, will go a long way into explaining to the people of this country and to the world where we're going and what we're doing. Because the other part to this is rates can only go so low. There is a certain risk to a mortgage-backed security. There are certain fees attached to it. So it's not like the Fed could actually put this down. I mean, the mortgage rates can only be down so far. So it's not as if the Fed could keep buying these mortgage-backed securities and the rates would end up having to be zero. They may end up continually buying these securities and rates could continue, to go down a little bit. They could stabilize, and in fact, even with the Fed buying $40 billion a month, rates could rise. So it's not a foregone conclusion. Time and circumstances will change that. But the point here is, it's time to step up to the plate and swing. What happens depends a great deal on what we do. It has a lot to do with who we are and how we approach it. You cannot hide from the issues. You cannot hide from bad news. You cannot hide from opportunity. You need to know what's going on in your market. You have to see how it plays into your market. I don't want you selling one position or the other, because taking sides can be very dangerous. It's one thing that you have to come to grips with. You are perfectly fine of having your own political beliefs, but be careful, because you don't want to cut off a potential client because of them. The mortgage market is not a Republican or a Democratic concept. Both of them would benefit greatly from a secure and positive housing market and a secure and positive mortgage market. But we have to caution against craziness. True professionals see opportunity and seize it. And the opportunity here is to get it right. The opportunity here is to pay attention, is to know what's going on and to understand this is a really big deal. Okay? What is happening with the mortgage market, what's happening with the housing market, has just been amped up to a very big degree. A lot of pressure has now been put on the market to make something happen. Whether people realize it or not, there's a lot going on, and you need to be aware of it. Because just last week, we could have been looking, again, with the G-fees of pushing mortgage rates, into the high threes, if not possibly into the fours, based upon all the things that were happening in the world. Add the G-fee, add the unrest in the Middle East, add all these things together, this uncertainty together, could have easily seen rates go higher. And for the fact that this is now where they are is an important thing to see how powerful a move this really is. But you have to know. You have to keep informed. You have to pay attention. And you have to communicate. I don't want you out there with 1,000 emails every 5 minutes telling people these things. I don't want you on Facebook out there telling people these things. I don't want you out there with YouTube video telling these people these things. I want you out there speaking to your referral partners one at a time. I want you out there speaking to your clients one at a time. This is not a mass media event. This is where you show your professionalism. You know some things. that a lot of other people in our industry are not taking into consideration. In fact, there will be people on the other side of our industry who will hype this to a great degree. And they will try to cause people to do things that they may not have done had they thought it through. So understand that. 100% of the truth, 100% of the time. You got to do the work. You have to do the work. This can't be about, apps on your iPhone or anything else. You must keep yourself informed. Never has it been more important to talk about 100% of the truth 100% of the time. Never. Because these are big decisions that people are going to be making, and there's going to be a lot of conversation about it if the media ever decides that this is where they want to go. But your customers have a right to know that this could be a volatile situation, and you must take steps to make sure that they are informed as to what the situations are and what they can and can't do. Remember, documentation beats conversation every time. Get your plan in writing. Know what your lock policies are. Know what your renegotiation policies are. Have them in writing. Make sure your people see them. Make sure that they acknowledge them. Because that can be a huge competitive edge over somebody who's just placating the situation or telling people, my favorite words, don't worry about it. The mortgage business is not a don't worry about it business. The mortgage business is a documentation business. And down at the end here, touch it once, get it right, and schedule the next action. People, don't waste your time doing half or 90% of the job. Please, the difference between those who do exceptionally well in the mortgage business and those that don't are the ones that understand this last principle. Touch it once, get it right, schedule the next action. Because the ones that win are the ones that show up. And I've told everybody that knows me on repeated occasions that this business is very straightforward. You have to show up, you have to follow up, you have to repeat the process, and you cannot become emotionally attached to the outcome. In fluctuating interest rates, with the possibility of significant rate movement, you get a lot of emotional attachments to outcomes. Stay away from that. Do not get involved with that. Touch it once, get it right, schedule the next action. You will never get in trouble following those simple instructions. So until next time, our next call is scheduled for October 16th at 1 o'clock Eastern. Again, any questions, any comments, success stories, please share them. The reality of this thing is this works when we all get connected. I love when you send me emails and tell me that you've been able to use something that we've shared to make yourself some money. I really value getting information from you about things that you're doing that maybe we haven't discussed or that you would like to discuss so that we can prepare and we can have them on these calls. There's a lot going on. I understand that. But I want you to be prepared, and if you need help or if you have a question, please email me. Let me know that you've got something going on. If I can't answer the question via email, we will set up time to talk about it and talk it through. And that includes if you disagree with me. I am not perfect. Nobody is. Disagreements happen amongst people who are really good at what they do, and we can have those conversations as well. So please, let me know if there's anything that you need from me or anything that you'd like to discuss, and especially if something you've done something that you've been able to take out of these conversations has turned into money in your pocket. With that in mind, I'll let you go about your business. Stay informed, keep in touch, and I'll talk to you guys next month. Take care.